There's like different tips and tricks. Okay, make sure you have an email, make sure you have a recognizable handle. And then they sort of weighed all the offers and they said, okay, we're gonna go with these 2 brand deals. And then the next day, he was in a conference room shooting the deals in between games. And so I can't even imagine like the sort of environment where you have these really intense competitive basketball games. And is there just a bunch of players on the sidelines making these TikToks?
Yeah, I can't imagine like Josh Lipton at 18 was not
making 30 grand on a quick 5-second
also
video.
being able to navigate all that is remarkable to me.
Yeah,
hopefully
very
they
much
give good
so.
guidance. Thank you, Brooke.
While also staying in the game, right? Of course.
That's right. All right, and you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. Coming up, we take a deeper dive into the convergence of AI and crypto. That's next on Market Domination. Crypto markets are in focus again, with Bitcoin rallying over the past month. But beyond price moves, some in the industry say the real story may be the convergence of crypto, artificial intelligence, and tokenized finance. Joining me now is Yat Siu, co-founder and CEO of Animoca Brands. Yat, it is great to have you, especially on set. Maybe start here, Yat, for viewers, the uninitiated, maybe not as familiar with the company. Help us understand what the company's about, just in simple terms. When I was reading up on it, it sounded like it's a tech company, but also a venture firm focused on blockchain and digital assets.
Yeah,
is that right?
In a way. I mean, we're a digital conglomerate. We have over 600 portfolio companies, making us one of the largest investors, basically, in the intersection of crypto and AI. In fact, we actually started doing AI investments back in 2018 and 2019, and basically also ventured into crypto back then. We're also basically venture builders. So we basically incubate companies and accelerate them. But many people know us because we were sort of big proponents of the metaverse. People know us for Sandbox and Axie Infinity and the gaming side of things. But actually, we're much more than that. And we're a global company with close to 600-700 staff around the world.
So investor and builder is the right way to think about it.
I think the way, and it's a conglomerate structure. In Asia, it's quite common. If you look at Asian companies, they do a lot of things as opposed to maybe companies in the West who focus on one or two things, for instance. But in reality, I think conglomerate style is probably what all the major corporations in the world do. If you look at Apple or Google or Facebook, they're not one business. They're actually many, many businesses. It might be wrapped looking like it's one business, but in reality, basically, they're sort of a multitude of companies, and we're the same.
Yeah, you said something interesting here, that the worst of selling in crypto, you say, could already be over. What are the signs, the signals, Yat, that suggest that to you?
Well, I think retail has been sort of fairly exhausted already last year, and we haven't seen a lot of retail come in, but the fact that the prices have held up the way that it is positive. I think the second thing, of course, is that, the level of fear is still very high. However, if you look at, for instance, the recent rally in Bitcoin and Ethereum, yes, it wasn't the peak of last year, but in comparison to where it was even 3 years ago, it's very strong. And I think the other thing is, of course, we've had major cataclysmic events between sort of war, October 10, various sort of bad meme coin launches from certain people, all sorts of stuff that basically have really sort of hurt the market. And the industry is not just standing firm, but it's actually stronger in the sense that look at all the movements that are happening in RWAs, all the institutions that are excited about tokenization. I mean, years ago, right, a financial institution wouldn't even touch the world tokenization, let alone crypto, and now they're all over it. So I would say, we're set up for prime time, and I would say the near future.
You have described Animoca as a leverage bet on altcoins specifically. Why that segment of the market? Why does that segment present the, in your opinion, smartest long-term opportunity?
Well, first of all, altcoins is the utility sector. So when you talk about tokenization, broadly speaking, that actually refers to altcoins as well. You're tokenizing something else. You're not sort of using Bitcoin, right? You're basically tokenizing an asset and creating a token out of that. So the entire altcoin space includes, in our perspective, RWAs and essentially these alternative asset classes, which is what people are so excited about. And it's a utility class of tokens. So if you think that crypto and blockchain are going to have a lot of utility in the future, they're not using Bitcoin, right? Even though that's essentially like gold. Basically, they're using altcoins, very similar to how people use Facebook or Nvidia or Microsoft. We think of them as a similar parallel. And if you look at the stock market, the stock market's like $120 to $130 trillion in size compared to gold's 26 to 27 trillion. That's kind of what we think is going to happen in the future as well. And again, it's because we use these assets, right? You use Ethereum, or you use Solana, or you use basically sort of, tokens in our ecosystem.
This was an interesting data point. You have invested in more than 600 Web3 companies. That's an impressive data point. How do you decide where to make those investments? How do you decide, okay, yeah, this is going to be a company that I think is going to survive and thrive in the next crypto cycle?
Well, I think the way that we think of this is that the internet, sort of blockchain is very similar to how the internet was back in 2001 and 2002, which means that we basically have to take sort of very sort of focused bets on a series of companies that are building everything. Everything that was built in the early days of the internet is essentially being built basically for crypto and Web3, but in particular in the focus of agentic AI, right? In other words, we think the entire sort of blockchain space is really built for agents. Right? And so from that lens, you have to rebuild all of the products and services in a slightly different lens for that, right? Which means that there's going to be hundreds and hundreds, actually thousands and thousands of companies that are emerging that are going to be really, really successful in the space. And we are not a fund, so we invest out of a balance sheet. So that means we can take the long picture. imagine trying to sort of index against the internet when you were back in 2001, 2002, and you said, okay, let me invest in some Amazon, maybe in some Apple, and eventually when Google went public or Facebook, we'd have an index on that, but you're a fund. Then 10 years down the road, you'd have to liquidate that fund, call it 2015. You would not nearly have captured the upside that was sort of happening in that space. Right? And we think we're best positioned to basically understand which of these companies are the fast emerging businesses. And frankly speaking, how do investors know which companies to invest in, particularly in the alternative space and in the space of these young startups, which were young before, and now we have many unicorns in our portfolio.
What are your thoughts, John, about U.S. regulation of crypto? What do you think regulators need to get right?
I think they need to really sort of define what is a security and what is not, and I think the U.S. is sort of driving that forward. The SEC and the CFTC are obviously coming to sort of an arrangement around this, which is positive. A lot of people are looking obviously at the Clarity Act. Whether that ends up basically coming out or not in time is a question mark on everyone's mind. It depends on basically looking at poly market. Is it happening or is it not happening? However, broadly speaking, the U.S. has already basically sort of shown what it defines in terms of utility token or not, at least in conversation. Whether it becomes law or not, the rest of the world is already following suit. They're all saying, okay, hold on a second, there's a distinction between something that is sort of a meme coin, which is basically a bit of a joke, compared to a sort of utility token that has real purpose, compared to RWA, which is backed against certain assets, compared all these categories around tokenization. People are having more clarity around that. And I think this basically helps regulators define what they should regulate and what they should not. And I think it's really pushed the world forward. It's very positive. I mean, the US was very hostile towards crypto really just a year and a half ago, and now it's become very positive. And it's also become much of a bipartisan issue as well. Sort of some of the issues aside, we do expect that the US will continue to lead in the area of sort of crypto regulation. And of course, if the US leads, the rest of the world tends to follow.
You have sort of an interesting global view, because we were talking off camera. I mean, you have offices in Hong Kong and Dubai.
Sure.
I mean, maybe end there. I'm just curious to get your take. Geopolitically, who does lead in crypto? Would you say it's the US?
I think the US has done a lot of catching up. The UAE, when you look at Dubai and Abu Dhabi, have been leading in terms of regulation and adoption in many ways because a lot of people have gone there. Of course, recently a lot of people had to leave, right, for different reasons. But Hong Kong has been leading as well. I mean, they've basically come out with, I think there's 11 license exchanges now in Hong Kong, for instance. Singapore was there earlier as well, Japan as well, right? But at the end of the day, the U.S. is obviously, has the deepest sort of, pockets in the space. Investors here in the U.S. have been raring to get into this opportunity, and they were not allowed to, and now they're all looking at that. I think the big unlock is if Clarity does pass, then basically corporations that aren't finance-oriented but consumer-oriented are going to say, okay, now I can launch a token, because now they have a framework, right? And I think that's the big unlock when Clarity happens. But at the moment, that's obviously still a question mark.
Yeah, so good to have you on the show today, especially on SED. Thank you.
Thank you.
Coming up, we've got you covered with all the action following the closing bell. Stay tuned. Stocks ending the day higher as oil prices retreat. Our very own Jared Blickery has the latest. Jared.
Thank you, Josh. Not only oil prices, but bond yields and the dollar too. And you translate that into stocks, we're looking at some pretty decent gains to end the day. Here's a chart of the Dow Jones Industrial Average up nearly 400 points, or about 0.8%. What you can see in the price action is that we started in the green and we maintained pretty high levels all day long. Wasn't a lot of indecision in this market today. That is a good sign. Here's a NASDAQ Composite, even better, up 1.2%. S&P 500 splitting the difference, up about 1%, but all the same chart really. And here's a Russell 2000 up 1%, though it gave back a little bit more than some of the other indices did. I want to show you what's going on with the VIX here, and this will be more relevant in a year-to-date chart. So we've been, here's the peak last week or a couple weeks ago, and we have been very, not steadily, but we've just been kind of staggering down. We're still a little bit elevated, 24, holding above 20. Before we came into all of this mess, we were right around the mid-teens. So we got some ways to go there, but nevertheless going in the right direction. Large cap stocks, everything in the green here. The two outperformers, tech and consumer discretionary, mega cap sectors, AI leaders, and what did the worst were a few defensive sectors, which is what you would expect to see on a bullish day. So energy and staples bringing up the rear. NASDAQ 100 looking very positive here. One note, CrowdStrike down 4%. That's the only dark red that I see. So that's a very nice looking heat map that we have there. Micron, one of the leaders, so is Lam Research. And I'll just dive into the semiconductors, and you can see Western Digital up 5, SanDisk 6, Marvell and ARM up 4 and 5% respectively. So a lot of strong gains there. Software, not too shabby. A couple of outliers there to the downside. I've mentioned CrowdStrike, but also Snow, and it looks like Okta down about 2.5%. If we go into the Dow, we also see a pretty strong board here. A few outliers to the downside. Walmart off not even 0.5%. Disney down a little bit more. Verizon off 0.75%, but none of these losers off more than 1%. And another one, transportation stocks, which were some of the worst hit on various days going back over a few weeks. These did pretty well today. The airlines especially outperforming. Delta, Southwest, United, all up more than 3.5%. United up more than 4%. I'll finish here. Here's my leaders, and it's been almost forever since I saw all of these green. Some of the best performers today, Korea, which as a country was up 7%, heavily levered to the chip trade, but Bitcoin up nearly 4%, IPOs, emerging markets, disruption stocks, solar stocks, that's the chip trade and quantum. So it's been a while since all of these kind of joined forces and we saw a broadly bullish day. Of course, it's only Monday. Be nice to see us in a very similar place on Friday there.
All right, thank you, Jared. Well, let's dive into what investors are focusing on today. Sam Stovall joins me now, Chief Investment Strategist at CFRA Research. Sam, great to see you as always. So as Jared was saying, listen, we finished in the green today, but it's been choppy. You say the SPX now roughly 5% off its recent high, on the verge of a pullback. As investors, do you look at this, as Sam, and say, okay, kind of just routine reset, or no, maybe the start of something more potentially concerning? Walk us through it. How are you looking at this market?
Sure, Josh. Well, good to talk to you again. Yeah, I'm surprised with the resilience of the S&P 500. It peaked on January 27th, which was the last all-time high. In January and again in February, we had the late economic cycle sectors like energy, materials, and industrials outperform the S&P 500, as well as the early defensive consumer staples. So maybe it was the market just sort of preparing for conflict with Iran. But even so, the market itself has yet to fall into a pullback. And some reassuring research shows that if it has taken more than 40 calendar days to decline by 5% or more, then history says that while we could get a pullback or a correction, we have never had a bear market. And that's certainly not a guarantee, but it's a very comforting statistic to say that it's given investors long enough to mull this over to decide, you know what, yeah, it might not be over just yet, but it's not going to be the end of this bull market.
Sam, oil being a key variable here, you talk about how the Strait of Hormuz, if that stays like it is now, that could keep oil prices above 100. If that happens, Sam, what does that mean for inflation, Fed, the economy? How do you try to think through that?
Well, it would not be very good. There's an old adage that a prolonged $10 increase in the price of oil takes off anywhere from 10 to 20 basis points from real GDP. And the most recent reading for GDP was a gain of only 0.7%. So the worry is that the longer we have high oil prices, just remember that most of the goods we get, we don't have a Star Trek transporter yet, so it has to be delivered via truck, et cetera. And with diesel fuel now more than $5 a gallon, that's going to be increased in the cost of delivery. You have petrochemicals that are involved in a lot of packaging, et cetera. So also with so many armaments being used up in Iran, the worry is that's going to be adding to the U.S. debt. So we saw a decline today in 10-year yields, but the worry is that it will have a deleterious effect on inflation and push out the next Fed cut.
Sam, interesting note out of Morgan Stanley, Mike Wilson and that team today, telling their clients, yes, near-term volatility, but still constructive, Sam, they said, over the next six to 12 months. Big reason there. Bottom line, they told their clients, Sam, earnings acceleration is continuing. Is that what you see?
Yes, I do. With the fourth quarter of 2025 essentially over, it has now been the 65th quarter out of the last 67 in which actual results exceeded end of quarter estimates. We're also looking for a double-digit gain in Q1 2026 earnings, with technology expected to post a greater than 40% year-on-year advance. So I think that's one reason why the market is feeling fairly confident right now that it can withstand a limited time above $100 per barrel of oil, mainly because overall corporate earnings are continuing to do quite well, and remembering that this is much more of a service-oriented economy than a manufacturing one.
Sam, also I thought it was interesting how you talk about the election year factor, how markets often struggle during midterm election years. So how should investors, Sam, sort of factor in political cycles into their market outlook?
Well, as Betty Davis once said, fasten your seatbelt, it's going to be a bumpy ride. Essentially, midterm election years have the worst performance on average going back to World War II, rising only 3.8% on average and posting a gain about 55% of the time, so no better than a coin toss. Also, we did close in this first quarter below the prior December low. That has happened in 76% of midterm election years since World War II, and points to an average decline for the full year of about 3.5%. Certainly not a guarantee, but again, the concern is that 62% of the time the market did decline when we had that lousy of a start to the year. Also, I add that the average drawdown is the worst in midterm election years, off 18%. But there is one bit of good news. October 31 of midterm election years through October 31 of the year after, the market has never declined, and the average gain was 16%. So if you can hold on until October 31, hopefully the skies will clear.
Here's another interesting data point in your research, Sam. The percentage of sub-industries trading above key moving averages has dropped well below, you say, historical norms. That's interesting. What does that suggest to you, Sam, about market momentum, risk appetite? What do you make of it?
Sure. Well, there are 155 sub-industries in the S&P 1500. That's the large cap plus mid cap plus small cap indices. And what I have found is whenever we have dipped below the 5% threshold, meaning that fewer than 5% of those 155 sub-industries are trading above both their 50 and 200-day moving averages, we're getting close to the point in which investors are throwing the baby out with the bathwater. Right now, however, we're only at about 25%, down significantly from a recent 66% reading. So it certainly confirms that we are losing, in a sense, the participation of many, many sub-industries within the broader market. But I think we have to wait until we move below that 5% threshold, as we did back on April 4th of last year, which signaled the end to that 2+ month near bear market.
Final question, Sam. What sectors are you overweight right here?
Well, the beneficiaries that we see right now for the higher oil prices would be the discount retailers, Dollar General, et cetera. Obviously, energy, the midstream natural gas companies, aerospace and defense, as well as waste services. But if we do get a pretty quick scenario unfolding like we did with the Iraq invading Kuwait back in 1990, then I see us popping pretty quickly. And those areas that did the worst in that area tend to be the better performers coming out of the decline.
Sam, as always, great to have you on the show. Thank you.
My pleasure, Josh.
Coming up, Okta's CEO shares how the company's navigating the software sell-off. That's next. The so-called SaaSpocalypse has sent software stocks reeling this year as investors worry that new innovations from AI startups will render software companies obsolete. Yahoo Finance executive editor Brian Sawsey sat down with Okta's co-founder and CEO to discuss how his company is adapting to the changing landscape.
Every company is figuring out how they're going to turn themselves into an agentic enterprise, which means agents are going to be added to their existing software. They're going to build their own agents. They're going to buy new agents from new companies, from existing companies, and they're trying to figure out how it all fits together. It helps them become an agentic enterprise. And we're releasing a blueprint for the agentic enterprise that helps them be a secure agentic enterprise. It's very confusing. Everyone's talking about agents. It's a revolutionary technology. We have Claude which is personal agents for everyone. We have agents from all our vendors. But we're helping customers understand how it all fits together, how the different cyber vendors interact with this ecosystem to make agents secure, how you can scan all of your environments to see which agents you have and see what they're connecting to, and finally see what they can actually do.
As someone that has been doing this for a while, like you have been, I mean, this has to be a mind-blowing moment for you. I mean, this stuff is crazy.
It's very, very exciting. We're talking about a massive technological change and revolution, and it's happening at every layer. Every SaaS company is figuring out how they incorporate these technologies into their product. Every company is figuring out which new SaaS companies they should buy, what they should build themselves, and there's going to be a whole new layer on top of this, which is true digital workers. So it's an exciting opportunity for a vendor. It's a lot of change, and we're really excited to release these new products and help our customers get there.
Are these agents making companies less safe?
These agents are making companies a lot of things. They're making companies have new products. They're making companies be more effective, more efficient. But there are risks with this. You already see all these new agentic capabilities released. What happened a week after Claude came out? There were a bunch of security vulnerabilities. In the fall of last year, Anthropic released a report saying how Claude Code was used for a massive cyber attack across multiple companies. So every technological revolution, there's risks and downside with it, which is why it's so important we have this blueprint, this industry blueprint that can really inform customers how it should all be stitched together to make sure they can be secure as well as productive.
Isn't it also important that we still have humans in the mix here?
For sure, yeah. The vast majority of agentic systems still have a human in the loop. It's all about balancing what the agentic systems can do, and more importantly, how the agentic systems can interact with multiple systems. That's one of the key things about this technology. It doesn't exist in silos. It really spans, if it's done right, it really spans multiple systems. So the connection between people and agentic systems, and then these systems between different agentic systems between themselves is very important, which is why identity management and what we do is so key, because these agents are a powerful new identity type. You have people, you have customers, you have employees. Now these agents are a powerful new identity type, and the connections they have to other systems and other resources in your organization is something we can manage.
What are investors not understanding about the impact of this agent era on companies like yours? I feel as though security is getting all looped together and it's being thought of in the wrong way. Yeah,
the first thing is, I think investors are thinking about this whole wave as very zero sum. They're really thinking about, okay, there's going to be one winner, and for every winner, there's going to be one loser. I think it's very clear that the pie is getting bigger for everyone. Software and technology is going to be far larger than it is now in 5 years, far larger. There's going to be winners and losers. Companies have to adopt this new technology and make their own systems agentic. We talk about agentic as something discrete now, but I think the term will almost lose meaning because all software, all technology will be agentic. Your existing applications will add agentic capabilities. There'll be new applications with agentic capabilities. Everything you build will have autonomous agents. And so it'll all be just software and technology. And we'll all be far bigger because if you look at the market, we spend about, software industry is about $1.2 trillion. But we also spend $1.8 trillion on people to do IT work. So the TAM for these systems just in the IT realm is massive. And then there's 1.1 billion knowledge workers that will all be made more productive in the broader economy. It's $30 trillion of spend in knowledge workers. So the TAM is massive.
Can Anthropic do what you do?
Anthropic is a model provider, and they're building capabilities and tools. It's very hard to switch into the security realm for a couple.
That's what I've been telling everybody.
Yeah,
I'm like,
yeah.
this is really. I'm not just saying this because you're here. I'm like, this view that an Anthropic or an OpenAI is going to come in here and crush SaaS companies overnight. I mean, it's totally wrong.
Yeah, the one thing that's very hard to replicate is the reputation and the trust. Because think about, theoretically, you could vibe code something like Okta. You also have to get a company to choose to use the vibe coded solution. And by doing that, they're giving up years of hardened reliability and resilience. They're giving up a system that's integrated to thousands and thousands of elements of the ecosystem. You're in a system that is proven to work and trusted and secure. So I think it's a pretty hard leap to make.
How are you using AI internally in Okta? And I bring this up because I was speaking to Robinhood's co-founder Vlad Tenev, and I was fascinated how he's using coding inside of Robinhood. And then I talked to Block's CFO. They've laid off a lot of people because of AI. I mean, the speed at which this is changing how they develop their business. I mean, it's certainly surprising me, but how are you using it?
I think the most important thing at Okta is being adaptable to change. And in a normal time, and when technology is maybe moving at a normal pace, you might think every year you want to change 20% of what you're doing. We've really amped that up. You need to change probably 40% or more of what you're doing. That could be process, that could be how you think about markets and opportunities in the past and how you go after new things. So we're really trying to tune the organization to be adaptable to change, and especially in the new products. Of course, in the areas like engineering and product support, we have heavy use of agentic systems, and we're building our own AI agents. We're deploying agents from our vendors, our trusted partners, and mostly just keeping open to change and making sure we seize this new opportunity as fast as possible.
How is this AI revolution changing the future of being an engineer at a company like yours and others like it?
Well, if you look at the last few technology revolutions, whether it was the internet revolution and the cloud revolution and the mobile revolution, it was all about building software, and there were new software technologies that came out in those waves. But it was all about building for a new platform, whether it was the internet platform with web standards, or whether it was cloud computing, infrastructure as a service, or mobile. This is very different because it's actually changing and disrupting how things get built. And that's why that aptitude for change is so important, because as an engineer, you really have to be open to new things. And just like everyone else, a lot of times engineers aren't open to new things. They like to do things their own way. And so we're really turning up the dial on, hey, we have to think about things differently. How you did something before, how you automated things, what parts of the workflow of creating a code and a product is done by people and what is automated by these agents. You really have to be open, because it is very powerful, and it's very innovative and disruptive for the software engineering process.
Unrelated to any of this, Todd, I just want to get this on the record by saying you pushed me into doing my first High Rocks. It was you. It was a year. Inspirational? I think it was 2 years ago.
Was it the carrot or the stick?
No, first you told me, I think we were at the Goldman Sachs Tech Conference, and I told you I started training for this event, and you're like, that's good, but did you do it? Did you sign up? I'm like, no, and that really pissed me off when you told that to me.
There's no better way than to get in shape than to do it.
Yeah, and then even back there, I'm like, I think I'm ready. They're like, how do you know you're ready? Like, I know I'm ready. Well, I'm almost ready, a couple months, but right. How's your fitness journey doing?
It's good. Just finished the CrossFit Open.
Very cool.
Had a pretty good run, so I'm very excited about it.
How do you train for something like that?
Just a little bit every day, just CrossFit every day.
Any good tips for me as I go to embark on my first High Rocks? Like, how do I survive something like this? How do you survive a CrossFit?
I think you just gotta do it, and don't try to do one big thing at once. Just make steady progress every day.
All right.
All right,
well,
a little bit more each day, a little bit more.
Thank you for your motivations through the years. I will talk to you soon. Todd, good to see you. Appreciate it.
Thanks for having me.
Time now for what to watch Tuesday, March 17th. Busy day ahead for investors with key earnings, fresh housing data, and focus on Nvidia's GTC. Going to start off on earnings. We'll be getting reports from Tencent Music, retailers including Academy Sports and Bob's Discount Furniture, and nuclear company Okta. Lululemon reporting fourth quarter results after the closing bell on Tuesday. Wall Street's expecting revenue to land near the better end of the company's previously guided 1% to 3% decline, with profits near the top of the range. Investors will also be looking ahead to the company's 2026 outlook and any updates on the search for a new CEO. Also reporting Tuesday, DocuSign focuses on whether the company can accelerate growth beyond its core e-signature business. Analysts expecting the company to guide for annual recurring revenue growth around 6 to 8% for fiscal 27. Investors will also be listening for progress in DocuSign's intelligent agreement management platform, which the company hopes will become its next major growth engine. On the economic front, February pending home sales data coming out on Tuesday. Economists forecasting the index to fall about 0.7% month over month, a slight improvement from the 0.8% decline in January, as high mortgage rates continue to weigh on affordability and buyer demand. And in tech, attention remains squarely on Nvidia's GTC, with day 2 of the event on Tuesday. This is coming after CEO Jensen Huang's keynote on Monday, saying he sees $1 trillion of demand through 2027. Coming up, I speak to a panel about Nvidia CEO Jensen Huang's keynote at the 2026 GTC conference. That's coming up next. Hello and welcome to Asking for a Trend. All eyes in the tech world are on Nvidia, kicking off GTC on Monday. CEO Jensen Huang giving the keynote address and touting the strong demand he sees in the near future.
We saw $500 billion of very high confidence demand and purchase orders for Blackwell and Rubin through 2026. Right here where I stand, I see through 2027 at least $1 trillion.
For more, we're bringing out David Miller, Chief Investment Officer and Senior Portfolio Manager at Catalyst Funds, and Maribel Lopez, founder of Lopez Research. Welcome to you both. David, I will start with you, maybe on that bogey, David, because so Nvidia is saying, okay, we're going to generate at least $1 trillion from Blackwell and Rubin chips through the end of 27. Now, the company had previously forecast the chips would bring $500 billion in sales by the end of 26. What do you make of that news, David, but also the stock reaction? Because we initially popped nearly 5%, but then we paired those gains and we actually finished the day up only about 1.5%. So run us through it.
Yeah, well, I mean, it's a little mind-boggling, the scale of those numbers, because, I mean, you look at last quarter, it was about $68 billion. I understand they're forecasting, I believe, $78 billion for next quarter. So to get to the trillion between Blackwell and Vera Rubin, I mean, it's pretty interesting, but I think that really implies that they're, not GPU-centric as much going forward as you got the GPU and the CPU and really a full AI stack that could potentially, I guess, get you to those numbers, but it's hard to see how all the math works, but clearly they've delivered before. So, if somebody's going to do it, NVIDIA's the one to accomplish those types of numbers.
Maribel, bring you in here as well. What'd you make of that bogey, Maribel, in the stock response?
I thought it was astronomical, but in some ways it makes a lot of sense to me. So what we see happening is there's just insatiable demand for compute. And we haven't even really tapped into enterprise buyers buying in a meaningful way. So there's a tremendous amount of headwinds. And when you started talking about tokens as the new commodity, it was a very interesting discussion. I remember when we had oil, I remember we had electricity, and now apparently it's AI tokens.
David, my colleague Dan Halley has a good write-up here because we also had some product news, right? So NVIDIA debuted a number of chips and platforms. Got an all-new NVIDIA Grok 3 LPU, language processing unit. Got a massive Vera CPU, central processing unit rack. Any one of those announcements stand out to you more than others?
I mean, I really found Animoca to be pretty interesting.
Why that one?
I think their ability to make OpenClaw more efficient and the ability to really reduce the power and increase the efficiency of using tokens really implies that they've taken it far beyond Moore's Law, that they're getting like 10x more efficient. That I think that really makes it almost hard to fathom what AI is going to look like 2-3 years out when you can compound your efficiency at those types of rates.
Maribel, you agree? Was it Animoca for you as well?
I think we have two things. I think one's sort of the sleeping giant moving forward. When we were talking about Grok, I don't think people really understand the future potential for Grok. When we're looking at real serious high performance computing that's going to use a lot of processing power, basically, Grok is going to be the answer when you look at things like scientific discovery, finance, energy. So that gives us a more long-term ability to make money with AI. But in the short run, really, that whole discussion around what's happening with OpenClaw, what's happening with agentic AI, that is really where it's at. That is the next wave of computing. That's where we're going to burn a lot of processing power. And that's really what people want. So I think that both of those announcements combined, one more short-term and then one more longer term, are going to be very powerful for the company.
David, let's talk about the stock for a second here, because year to date, you're in the red. Over the past 6 months, you're up about 4%. What is going on there? What do you think is an overarching concern investors have?
I think it seems to be that they're just doubting the numbers that Jensen's suggesting, because when you hear the numbers he's forecasting, that doesn't compute to the stock being up as little as it is today, or having taken a bit of a hit so far year to date. Clearly, there's been a transition from tech stocks into energy, but what's going in terms of the growth rates of AI and the incredible efficiency in AI doesn't really jibe with the stock price getting hit year to date. So it's a good question.
Maribel, what do you make of that stock reaction? I mean, I've heard some folks say, listen, maybe investors, they look at all this big tech AI spending, historic spending, and they're just skeptical, Maribel, it can actually continue at this pace, and so they're skeptical of downstream winners like at Nvidia.
There's been a lot of discussion in the market right now about how much is being spent on AI versus how much we're seeing in actual productivity and revenue gains and other things. So there seems to be a mixed match between what's being spent and the opportunity that we're supposed to be capitalizing on as a result of that. But I think the real reason that the stock didn't pop is that every time we do one of these conferences, we expect there to be this big bang blowout new technology. And we did talk about new technology moving in the 2028 timeframe. And I think that we've seen a lot of the announcements, but everybody's always looking for that little rabbit in the hat that they can pull out. And they're not sure that they found it in this. What I think is more interesting is the size and scale of the numbers that he did talk about that could be delivered from the existing computing platforms that he's already announced. So this might be a case where people spend some time and they think about it, but I would say that it's really difficult to figure out if the AI spending creates the same amount of AI value. And that's the thing I think that everybody's looking at in the market, trying to figure out, is this overvalued? Should we be looking at someone else? Is like this the thing? And I think we will see a lot more compute bought. But the question is, can there be more upside for these AI companies?
Separately, David, AI disruption fears front and center for software. Jensen Huang has been one of those executives who's publicly kind of pushed back against that. I'm just curious your take.
Yeah, I mean, it's interesting because you are starting to see some of those layoffs, whether it was Meta. Now, I mean, that might be more to finance some of this CapEx that they're doing, but you've certainly seen it at Block as well. So I think there are some legitimate concerns. However, there really hasn't been a scenario historically where improvements in technology have led to less employment. It certainly led to shifts in employment, but maybe AI really will be different. It does seem like a very different type of technological advancement than historical moves.
Maribel, I end here with you. You know, it's Nvidia, it's GTC. There's a lot of exciting announcements, products, partnerships, platforms, and Nvidia it's the face of AI, Maribel. But AI increasingly looks like it has a kind of a PR problem, Maribel. I don't know if you saw this. There was this NBC News poll where the majority of voters say the risks of AI actually, in their opinion, outweigh the benefits. That is not great. And I'm interested to get your reaction to that. Does that surprise you, Maribel, that folks feel that way? And what should NVIDIA and the broader sort of AI ecosystem's response to that be?
Now, I think we saw such tremendous enthusiasm over AI, and we didn't think at all about the potential risks or downsides of it. I think in the past, say, 6 months, we've thought a lot more about that. And when you look at what happened at GTC, when he was talking about OpenClaw, he talked about trying to create a private, secure, governed discussion of how we move into agentic AI, which has largely been missing. We've had it in a few of the hyperscaler conversations. So I think we don't feel we have the proper guardrails to keep this from going off the rails. And I think that the tech community needs to talk more about that. We have some lingering concerns about what AI models can and should be doing. And I think we're still going to take some time to work that out. But it's not necessarily quite a technology problem. I think we finally caught up with, hey, there are pros and cons to everything. And you have to be really thoughtful about how you deploy technology, particularly in an AI era.
Maribel, David, thank you both. Great discussion. Appreciate it. Stick around. Much more Ask for a Trend. That's still to come. So U.S. stocks starting the week off on the right foot, climbing into the green as oil prices pull back. Yahoo Finance's Jared Blickery joining us now with trading takeaways. Jared.
Thank you, Josh. Nice to be at the desk with you.
Sure is.
Oh, let's talk about this risk on day and go to the Wi-Fi Interactive. I'm emphasizing day because we'll have to see if this lasts. We haven't seen these nice days turn into nice weeks in the last few, well, probably the last month. But let's go through some of the good news and evidence right here. Start out with the S&P 500. It was a gap day up and it held on to a lot of that strength. Here's a prior close, just held it throughout the entire day. So that is a very good risk on sign. Then you go all the way down to the small caps. Russell 2000, well, they were up 1%. Then you go all the way up the cap curve to the Magnificent Seven, the 7 biggest stocks in the world pretty much. They were up even more, 1.5%. So you saw a lot of solid leadership there. And if you take a look at the sector action, everything in the green, and the old stalwart tech, that is in the pole position up 1.5%. You take a look at the NASDAQ 100, a lot of green there. Nvidia, their big tentpole event, that doesn't hurt because they are in the green and they were the original leader of this AI rally. A couple things worry me a little bit. Stocks. So let's take a look at the S&P 500. Here's the year to date. I was harping on the 6,800 level forever because it was just this huge floor support. As long as we're below that, we still have the risk that short sellers can reassert. And that can happen anywhere up to about 6,850. We clear that, and that's I don't know that it's the all clear, but it's a substantial improvement. But we're still kind of in the bottom end here, and things can turn around very rapidly. And then the other thing is crude. We're celebrating this rise, this fall in crude oil. It's still at $94 basically. It punched above $200 or $100 a barrel, not 200 yet, 100 last night on the open. And so this is nice that it's come down and it's down, 4 or 5%, but we got a long ways to go because $94 is still pretty high.
So if I'm a trader, I'm an investor, I'm seeing this green on the screen, I'm wondering, all right, does this rally have legs? What do you say?
That's a great question. And for me, I go back to my old stalwarts, the dollar and the US dollar index and also yields. And we can go to the Wi-Fi Interactive one more time. This is my second slide here. And so let's check out what's going on with the US dollar index first. We're still on crude oil there, but I'll pull up the dollar. There we go. So this is the 2-day view, and similar to oil, it punched above 100. Pure coincidence that they're talking about the same, numbers and levels. But then it sunk to 99.81. That's a move in the right direction. If you take a look at we don't have the 1-year chart on there, but if you take a look at the 5-day chart, it's moving in the right direction short term. But I would like to see lower index prices for the U.S. dollar index. And then conversely, if it moves above, that just puts huge stress on the market, and that dollar pain trade can leak into everything else. Secondly, long-term yields, 30-year T-bond yield. Here it is at 4.86%. It was down 5 basis points today. That is another cap in the feather of the bulls, but it's only a short-term signal here. I've shown this chart a lot with your audience here, Josh. Over the last 3 years, we have punched above 5% in the 30-year a number of times, and every time it did, stocks rolled over. So my thesis is if we get a sustained move above 5%, that really turns the screws. And I got one more chart here before we move on. Just wanted to show you, I'm writing about the effects of the US dollar index and bonds on this inflation spike. Here's a chart from Macro Alf, Alfonso Pecatiello of the Macro Compass, This is WTI crude futures for December in white. In green, it's expected inflation in Europe. And see this green line? It is just perfectly matched to crude oil. Just goes to show you that this has real world effects almost in real time. Unlike Europe, we are net energy exporters, and so we're not affected as much, but we do have a release valve, and right now, it looks like it's been the US dollar and bonds. Not today, but on a longer term basis over the last few weeks, so that's my pain point.
Any other key markets, canaries, so to speak, you'd be watching?
Yes, we got a couple canaries trying to sing here. So let's go to the Wi-Fi Interactive one more time. And I'm going to show you what's going on with Bitcoin. There we go. We got those canaries trying to sing. Bitcoin's in a minute if we got time. But first I'm going to show you the transports, because the transports on Thursday, Friday, this is a 3-year chart. You can see how they leapt up to new highs. They were making records, and then they have come back down to old support. Well, that old support line, I'm going to bring this down to a year to date, hit on Thursday and Friday is a 100-day moving average, and it's right below 18,000. 18,000 was my rough line in the sand. So transports are hanging on, but we want to see them higher. And I'll just give you a quick heat map look at today's action in the transports. Okay, looking pretty good there, but over the trailing month, that is a lot of red, so there's more territory to be clawed back.
All right, thank you, Jared. Appreciate it, my friend. Stick around. Much more As for a Trend still to come. BlackRock is launching the Staked Ethereum Trust ETF. Julie Hyman spoke to BlackRock's head of digital assets about this new asset.
Well, the Iran conflict actually has proven to be a bit of a catalyst here. Obviously, going back to October of 2025 when Bitcoin made its all-time high, there was a period of severely negative price action. But what we've seen is since the Iran conflict broke out, a pattern that's actually been quite consistent in a lot of sort of big, globally disruptive geopolitical events, which is that the first move in Bitcoin can be somewhat unpredictable in the very short term, but then within a couple of weeks or sometimes less, it starts to actually rally when these big destabilizing things happen. And so Bitcoin has outperformed just about every other asset class since that conflict started. It's up about 10%. Ether is actually even hotter. Ether's up over 15% since it started.
Does that imply that if and when it ends, that we could see some of that come off?
Well, the market's not always so rational on these things.
No, imagine that.
There's a duality in a sense to Bitcoin these days, which is there's elements of it that people view and trade like a speculative risk asset, even though I'm not a big fan of that framework. I think it's overly simplistic. Right. And there's elements that people look at it as a diversifier and a hedge against some of the turmoil and other geopolitical and monetary type risk factors that exist in the world. And so right now it's benefiting from the latter a little bit as this uncertainty swirls, Bitcoin being this global, decentralized, scarce monetary alternative that exists outside of the traditional financial and any country-specific risk. It's benefiting. We also see times where, for the same or opposite reason, when other conditions loosen, that it benefits too. That duality is something that confuses investors a lot of the time, and it's a reminder just of the importance of taking a long-term view, because over the long run, the fundamentals play out. Over the short term, it can be anybody's guess.
Yes, that is true of a lot of things, but probably true of crypto even more than other types of assets. All right. Speaking of things that are not entirely clear maybe to people, let's talk about staking for a moment, because this new ETF is a staking ETF. Staking has been something sort of that's been in the crypto native world for a long time. it's not necessarily a concept that everyday investors who are used to investing in equities are familiar with. So I guess first of all, like, what is staking? What do people need to know about what it is?
Sure. Well, it relates to the way that these blockchains operate. So take Bitcoin, that uses the proof of work consensus mechanism, which works very well for Bitcoin and its purposes. There's no role for holders of Bitcoin in that maintenance of the network process. But in Ethereum and many other blockchains, there actually is. And Ethereum uses what's called proof of stake, where actually the holders of Ether have the option to participate in the validation and the maintenance of the network. And when they do that, they earn a yield as compensation. So that yield can fluctuate based on various points in time, but it's a little over 2% today. And that creates a unique dynamic when you're trying to build products in this space.
Is it similar to, in the equity world, sort of lending out your shares? Is it a sort of similar concept?
It's similar in that both can generate yield on an underlying holding, but the actual mechanism and the reason that you're being compensated are different.
Got it. Okay. So how does the ETF work?
So in this case, with ETHB, which we just launched last week, so it's very exciting development for us, just our third product in this space in the US market, and obviously IBIT and ETHA have been tremendously successful. So with ETHB, unlike with ETHA, there will be staking on the majority of the Ether held by the fund. And so that allows investors in ETHB to participate in the staking rewards of the Ethereum network and earn a yield that they wouldn't otherwise get.
And so is the idea that, you know, the price of the ETF moves along with the underlying price of the asset, and then you also get yield along with it?
That's exactly right. Yeah.
Okay, gotcha. Well, and what is who's the audience for this? Is it just the crypto audience who's buying IBIT and ETHA, or is it a more crypto native audience, a more sophisticated audience? How are you guys thinking about that?
So first, with existing Ether investors, we think that a majority, but not all, of Ether ETP holders will prefer ETHB, the version with staking.
You would think so, all things being equal, if you're getting a dividend.
That's right, but we wanted to do it in two separate products to give investors choice, because we do think that there's some subset of the market that's going to prefer the fully unstaked version for just maximal liquidity and flexibility. But for the sort of longer term buy and hold investor who wants to capture that yield, ETHB is likely to be their preferred product. Now, in terms of additional investors that it may bring in, there certainly are some who have been given pause over allocating to the space because of the absence of yield. And so the entry of this creates an attractive vehicle for that. And it's almost like the way that IBIT, for many different types of investors, proved to be almost a silver bullet for having a convenient, turnkey, low-cost, accessible exposure vehicle for Bitcoin. Now we basically have that for Ether in a way that we didn't before, because you can get through an ETF all that exposure, including the staking yield.
Gotcha. Okay, really quickly, 30 seconds. What's next? I know you just came out with this thing, but you guys are very sort of slowly and deliberately becoming one of these products. What are you planning your next one already?
Well, we're responding to the market, and we're responding to where our clients are. And so that's why we've taken, I think, a little bit more discerning approach to new product launches. You know, many in the space have been proliferating in terms of the number of products they offer. I don't think you're going to see widespread proliferation of product offerings from us, but as other assets or concepts mature and reach the point where we believe there's a real solution that we can provide to clients, then we'll do that.
That's a wrap.